Plug Power Inc. is currently trading at $3.87, down 0.26, a significant drop of 6.30% in today's session. Now, a decline like that, on the surface, might just seem like another rough day for a notoriously volatile stock. And many will write it off as the market's continued skepticism about the green hydrogen space. The common belief is that Plug Power is a perpetual jam tomorrow company, always on the cusp of a breakthrough that never quite materializes, burning through cash with the hope of one day dominating an industry that is still in its infancy. Most investors see the stock as a high-risk bet, a lottery ticket on a green future that feels perpetually just over the horizon. But that perspective, while understandable, misses a critical shift happening underneath the surface. The reality is that the current price action isn't just about sentiment. It's a direct reflection of a much deeper, more complex tug-of-war between operational milestones and brutal macro headwinds. The market is pricing in the fear of dilution and the high cost of capital, while simultaneously ignoring the tangible progress the company is making in building out its hydrogen infrastructure. This isn't just about a dream anymore. It's about the harsh economics of making that dream a reality in a world of high interest rates. Let's break down what's really driving the stock today. The trading volume we're seeing is elevated, suggesting this isn't just passive selling. There's conviction behind these moves. Institutional investors are likely re-evaluating their positions in high-growth, cash-intensive companies like Plug Power. With the Federal Reserve maintaining a hawkish stance, the discount rate applied to future earnings gets higher, making speculative plays less attractive. For a company like Plug, which isn't expected to be GAAP profitable for some time, this is a direct punch to the valuation. Many investors using platforms like Schwab Intelligent Portfolios or Fidelity are being automatically rebalanced away from higher-risk assets, and Plug Power is a prime candidate for that kind of portfolio adjustment. It's a classic flight to safety, and volatile names are the first to be jettisoned. This is where the narrative of a struggling green energy company gets reinforced. You see the red on your screen and think the thesis is broken. But that's just one side of the coin. The other side is the operational reality. Plug Power has been making significant strides in its vertical integration strategy. Their green hydrogen plants in Georgia and Tennessee are now operational. This is a monumental step. For years, the company was primarily a seller of fuel cells, dependent on third-party hydrogen suppliers. Now, they are becoming a producer of the fuel itself. This transition from a hardware company to an integrated energy company is fundamental to their long-term value proposition. It allows them to control the entire ecosystem, from hydrogen production and liquefaction to storage and delivery. This vertical integration is designed to eventually bring down the cost of green hydrogen, making it competitive with traditional fuels. The market, however, is so fixated on the daily cash burn that it seems to be overlooking the strategic importance of these assets coming online. It's a classic case of Wall Street's short-term focus clashing with a long-term industrial build-out. The expectation is for immediate profitability, but the reality is that building an entirely new energy infrastructure is incredibly capital-intensive and takes time. So, what does the company actually do? At its core, Plug Power is a leader in the development of hydrogen fuel cell systems that replace conventional batteries in equipment and vehicles. Their primary market for years has been the material handling industry. Think forklifts in warehouses for companies like Amazon and Walmart. The value proposition here is simple. Fuel cell-powered forklifts can be refueled in minutes, whereas battery-powered ones take hours to recharge. In a high-throughput logistics environment, that uptime is incredibly valuable. This has been their bread-and-butter business, providing a steady stream of revenue. But the bigger vision and the reason the stock attracted so much attention is the expansion into larger markets, stationary power for data centers and other critical facilities, and mobility applications like heavy-duty trucks and vans. The company's business model is evolving from just selling fuel cell engines to providing a complete turnkey solution, which they call a GenKey offering. This includes the fuel cells, the hydrogen fuel itself, storage infrastructure, and ongoing service. It's a much stickier, more comprehensive model that aims to lock in customers for the long term. Looking at past performance, the stock has been a roller coaster. It saw a massive surge in late 2020 and early 2021, caught up in the broader clean energy euphoria. Investors were piling into anything green, and Plug Power became a poster child for the hydrogen economy. Many retail investors using apps like Robinhood and SoFi Invest jumped in, drawn by the narrative of a cleaner future. The stock soared to highs it hadn't seen in over a decade. But since then, it has been a painful ride down. The company has faced challenges, including accounting restatements, persistent cash burn, and delays in getting their green hydrogen plants fully ramped up. Each earnings report has been scrutinized not just for revenue growth, but for gross margins and cash flow. The company has consistently generated negative cash flow as it invests heavily in building out its production network. This is the crux of the bear case. Critics argue that the company's business model is fundamentally flawed, that the cost of producing green hydrogen is too high, and that they will be forced to perpetually raise capital through dilutive stock offerings just to stay afloat. They see a company that is constantly promising a bright future, but consistently failing to deliver on profitability. Many who use self-investing tools on platforms like Interactive Brokers have likely set tight stop losses on a stock like this, contributing to the downward volatility we're seeing. Now, let's pivot to the future outlook, because that's where the real debate lies. The path forward for Plug Power is fraught with both immense opportunity and significant risk. The bull case hinges on a few key catalysts. First and foremost is the successful scaling of their green hydrogen production. If they can ramp up their Georgia and Tennessee plants to full capacity and begin construction on other planned facilities, they can start to significantly bring down the cost of hydrogen. This would not only improve the margins on their existing fuel and service contracts, but also make their offerings more competitive against fossil fuels and battery electric solutions. The second major catalyst is the expansion into new markets. The stationary power market in particular is a massive opportunity. Data centers have an insatiable appetite for power and are under increasing pressure to reduce their carbon footprint. Plug Power's fuel cell solutions can provide clean, reliable backup power and potentially even primary power for these facilities. A major contract with a hyperscale data center operator would be a huge validation of their technology and a significant boost to the stock. On the mobility front, the heavy-duty trucking sector is another key target. While battery electric trucks face challenges with range and charging time, hydrogen fuel cell trucks offer a more direct replacement for diesel in terms of refueling speed and range. However, the risks are just as substantial. The biggest risk, without a doubt, is execution. Plug Power has a history of over-promising and under-delivering on its timelines and financial targets. Any further delays or cost overruns in their hydrogen plant build-out would be severely punished by the market. The second major risk is competition. The hydrogen space is becoming increasingly crowded, with major industrial gas companies, energy giants, and other startups. Plug Power needs to demonstrate that its technology and integrated model provide a durable competitive advantage. And finally, there's the macroeconomic risk. A sustained period of high interest rates will make it more expensive for Plug Power to fund its ambitious growth plans. The company will likely need to raise more capital in the coming years, and if they have to do it at a depressed stock price, it will result in significant dilution for existing shareholders. This is the fear that is currently weighing so heavily on the stock. It's a race against time. Can Plug Power reach a state of positive cash flow before it runs out of financing options? This is where where the expectation versus reality framework becomes so crucial. The market's expectation is for a clear, linear path to profitability, but the reality of building a new industrial sector is messy, expensive, and non-linear. The daily stock price fluctuations are noise, driven by macro fears and short-term sentiment. The real signal is the operational progress. Are the hydrogen plants producing at their expected capacity? Are the costs coming down as projected? Are they signing new customers in their target expansion markets? These are the questions that long-term investors should be focused on. I want you to comment below. Do you think green hydrogen is the future of energy, or is it a dead end? Let me know your thoughts. In summary, the 6% drop in Plug Power stock today is symptomatic of a market that is deeply skeptical of high-growth, cash-burning companies in the current economic environment. The prevailing expectation is that the company will continue to struggle with profitability and will be forced into dilutive financing. This narrative, however, overlooks